Well, happy Monday, everyone. We're going to give it just a few seconds here while everybody joins up to the webinar.
Yeah, folks popping in.
Awesome.
Well, good. We'll go ahead and get started. I'm Greg Patterson, and I am joined with my teammates J.A. Kennedy and Tara Gould. And we are with Atlantic Wealth Management here in Morehead City. And this is our November market and economic update. This is the 10th one this year that we've done. We try to keep these each month for you folks, and this will be our last one this year before we join back together in January. And the fourth Monday in January is the 22nd. So we'll be back with you then. But today we have much to be thankful for on the heels of Thanksgiving, and I trust you and your family and your loved ones had a great Thanksgiving and were able to enjoy time together. I know we did, as our team talked about that earlier this afternoon, and just all the things we have to be thankful for. And so it is in that spirit that we join with you today. And we have a lot to talk about, so we're going to go ahead and get started. These calls each month really cover a variety of topics, and we even include a financial planning topic in there. Today, we're talking about year-end giving. We're also going to give you an update on our thoughts on the economy with our U.S. recession indicators dashboard that ClearBridge puts out. So that'll be fun to come to that and talk through that. If you have any questions or have feedback that you'd like to give us, we certainly welcome that. And you can send us an email. Mackenzie has been great at taking those and getting those to us. So you're welcome to send her an email at mackenzie@myatlanticwealth.com, or you're always welcome to share it with us by calling the office 515-7800. We thank you for your feedback and just for your participation in these. So let's take a look at our agenda today. As I mentioned, we're going to talk about market returns. And so we have that data up to Friday's close. And then we're also going to be looking at inflation trends, both at the consumer level and also the producer level. We're going to talk through economic data as we see it from the last quarter. We've got third quarter GDP and results in to be able to share with you. And then the U.S. recession dashboard of indicators will be an insight into what that looks like going forward, sort of a forward thinking look into the future, the near term. We're going to talk through year-end giving, and then we're going to share some conclusions at the end of today's webinar. So with that, let's go ahead and get started with current market trends and returns. Terry, you want to share some insight on that?
Yeah, absolutely. These are times when I really enjoy talking about the market. So first start we're going to look at today is the S&P 500. This is year to date, so January through today, actually through earlier this morning. Remembering that the S&P 500 is 500 of the publicly trading companies, leading publicly traded companies, and they're based on market capitalization. We do quote this index as it is considered one of the best gauges of the U.S. equities market. So the most recent year to date market low, this occurred very, very early on in January. The market dipped down, trading in around 3,800. And happy to report that we are currently trading over 4,500. And that puts us at a year-to-date increase of over 19%. Next, we're going to take a look at the 1 year. The 1 year return has been going back and forth today between 14 and 15%. Close of the market, I think it was slightly less than 15%. To dig a little deeper into this, the 52-week high went just over 4,600, so we're really, really close to that. The 52-week low was right under 3,500. And so we're currently trading in that 4,500 range, which puts the 1 year index over, up over 15%. And then on this one, we're going to take a look at the past 5 years. In this time frame, we did have a low in March of 2020. This is just an interesting look when I look back over 5 years. In 2020, the index did dip down to 2,300. And the high range for this 5-year period was actually in December of 2021 at over 4,700. And this was going into 2022 when we were seeing those highs. And this perspective shows us that we're pretty close to getting back to that December 2021, January 2022 highs. We're off about 150 points. So the 5-year index on the S&P 500, as you can see, is up over 65%. And then we're going to take a look at NASDAQ. NASDAQ index is another staple in financial markets and something that we look at constantly. NASDAQ is over 3,700 companies. And these are heavily weighted towards technology. Actually, more than half of companies in the NASDAQ index are tech companies. NASDAQ had a year-to-date low in January, just like S&P 500. Down in the 10,000 range, this index was trading at. And then we had a peak in July, and that peak is really, really close to where we are at today. So in July of 2023, we hit 14,358. And as you can see, we're currently trading in the 14,300 range. So that puts us at a year-to-date increase of over 37%. And then next up is the 1-year look at NASDAQ. This is 52 weeks. We had a high, same time frame in July of that 14,358, and the low was 10,305. And so this is looking at 2022 through 2023. That puts us as a 1-year, year-over-year increase at 29%. And then lastly, again, that longer term perspective. This 5-year view shows us the journey that we've been on. Over the past 5 years, the NASDAQ is up over 95%. So it's similar with the S&P 500. We're looking January 2022 as a high point. In the 5-year range, the NASDAQ was trading over 16,000. And as you can see, we're on our way. We're off that high about 1,700 points.
Thanks, Tara.
You're welcome. Thank you.
Good afternoon, everybody. We're going to transition from market to the economy and talk about just some economic update information. We've had this consumer price index chart in for the last couple months, or maybe few months. And that's because inflation really has been at the forefront of economic news over the last 1.5 years plus. It's been a big driver of what we've seen with interest rates and how that has flowed through to the rest of the economy and where we are today. So this chart just goes back over the last 12 months and tracks the consumer price index. And you can see back October of 2022, we were in the 7 to 8% range overall. Now we have dropped into the 3.2% range as of last month. Interesting to note that we had a pretty significant downward trend continue from July of last year till June of this year. And then the CPI ticked up for a few months. And this past month, we saw it drop back down. So the market really liked that news that the CPI dropped back down. If we think about the way the market reacted in August, September, and October, it did react negatively to the increase in CPI. So we would hope that that trend would continue of decreasing inflation. And then this just a chart that shows from a month-to-month basis what CPI has done. Interesting to note just that really we had no change in the latest number if you look at October of 2023. So when you throw several zeros or 0.11s in the month-to-month gains, that's going to help us to bring down the overall annual 12-month rate of inflation back down to the 2% target that the Fed's after. And then we thought it was worth covering when we talk about inflation decreasing. We don't mean that prices are decreasing. We just mean that the rate of inflation is going down. And this chart kind of shows you the bottom orange dotted line. It would be the rate would be prices if we had continued at 2% rate of inflation. You can see in 2020 and 2021, we actually dipped under that 2% in terms of annual inflation rate. But we definitely have moved forward beyond that. Even if from this point forward, we were to drop back down to 2%, you can see there that prices are 10+% higher than they would have been having continued at 2% rate of inflation. So don't think we're going to go to the grocery store and see that our $100 5 items for $100 is now going to drop back down. But hopefully we will continue to see that rate of increase slow down. And that's what we're looking for. What we have done is kind of cover just the high level economic updates from month to month. And so we'll jump in on that. We did already mention the CPI and the trend there. We've had the same trend on PPI, which measures producer prices. That's actually lower than the CPI currently. It's 1.3% over the last year. If we look at producer prices as a leading indicator to consumer prices, then we would think that 1.3% would indicate that there is some opportunity for the CPI to come down over time. Employment and initial jobless claims, the latest employment data, unemployment number, unemployment ticked up slightly from 3.8% to 3.9%. This is data as of the end of October. So slight uptick in unemployment, nothing that we're too concerned about at this point. And in fact, the Fed they projected and really they've really desired with this increasing rate environment to see some increase in unemployment. So that's where we are currently. The initial jobless claims number has remained in a very reasonable rate, where we're looking at between 200 and 250,000 weekly initial jobless claims. We were on the lower end of that over the last couple of weeks. So on the unemployment or on the employment page, we would say unemployment's higher, which normally we would say is a negative, but we're not extremely concerned about that. Initial jobless claims have remained at a very reasonable level. And we have a lot of job openings still. We're still at a record number of job openings. I think we last looked at 9 million job openings. So we would think there would be some opportunity for the unemployed to gain employment through some of the job openings. From a housing market standpoint, this is kind of a trend we've talked about before, but existing home sales are down more significantly than new home sales. If we look at existing home sales, they're down about 14.5% over the last year. New home sales were up on a month-to-month basis last month, but down on a year-over-year basis. And I think that's to be expected with the interest rate environment we're in currently. Jump into retail sales and consumer spending. We're still positive on retail sales from 12 months ago. So retail sales are up 2.5% from a year ago. If we compare that to the rate of inflation, the CPI at 3.2, not quite keeping pace with inflation, but still increasing on a year-over-year basis. And then industrial production, this has been an area of weakness of late, and we had another decline in industrial production the number reported last month. So something we're continuing to keep watch over as we go forward. But on an overall basis, gross domestic product, which measures overall economic growth, the third quarter GDP number was at 4.9%, which compared to the first and second quarter that came in at 2% or a little over 2%. That's a very, we would call that a very, very good growth rate. And that's an annualized rate for the third quarter. We always have to wait a month after the end of the quarter to get a next quarter report on GDP. So the next report will not be until the end of January. But even if we have a little bit of a slowdown from the third quarter in the fourth quarter, there's still some room for that at that 4.9% annualized rate. And then the Fed and interest rates is the last bullet point there. The next meeting is the 13th of December, or the next Fed rate decision. And we would look to the data that comes out between now and then to try to give an indication for the action that the Fed will take. I think if we continue to see some more muted economic news, then maybe we don't get a rate increase. And but going forward, I think the Fed has emphasized they're going to be data dependent. They're going to pay attention to the most recent economic news and decide on interest rates accordingly. They're still trying to tightrope their way to a soft landing scenario where we avoid recession and move on to the next period of expansion. So that remains to be seen. We're not placing our eggs in any one basket on that. I'll pass it off to Greg.
Yeah. Avoiding a recession, we tend to see this as a normal part of the business cycle. And I believe if we polled our clients, they would want us to try to avoid a recession, but that's somewhat difficult to do and probably more of a natural part of the process, right?
Yep.
Seeing peak to trough, there is a recession in the midst of that, but there's an expansion and recovery on the other side of the trough. So when we put portfolios together, we're doing that with the thought that there would be a recession in the mix. So we also want to bring news headlines to you guys to share with you what we're seeing out there. Sometimes these can be a little opposite from one week to the other, depending on what's happening. And it takes a really long-term situation like investing for your retirement and through your retirement and puts it on the front page of any newspaper or any social media, or in this case, I believe this came from CNBC, to make you think there's something you should be doing every second of the day. This one says bad news for the economy is good news for the stock market, as long as it doesn't get too bad, and it references the U.S. payrolls increasing by 150,000 in October, which was less than expected. And I think that was what shot markets up at the beginning of November, where we saw the big rally. If you've looked at your investment statements or gone online and checked those, you've seen the prices are up. They were 20,000 fewer than expected, but the difference was mainly attributable, I think, completely to the U.S. auto strikes, which appear to be over now. So the Federal Reserve, I guess the relatively muted job creation coupled with wage gains led them to really not having to do anything. So it can just continue to let the data flow in without having to move on interest rates, which is what they said at the beginning of the month. We'll see, as J.A. alluded to, what happens on December 13th. They're data driven, and I think as long as we see things in line, they will not raise interest rates. They've already done 11 hikes, probably the fastest we've seen in quite some time. So I think they got what they were looking for with a meaningful slowdown in the labor market. We'll see. I'm sure the news headlines will continue on. And the fact is, as we've shared with many of you, if we took 100 years of the worst news headlines and laid them on the desk, you would see it would be a terrible thing to invest money. But had you done so over that time period, you would have been well rewarded in spite of the negative news, in spite of recessions, wars, inflation, etc. It tends to be that stock prices over that time go up. And that's part of, I think, investing is understanding the risks and then participating in those along the way. So one of the things we've been bringing to you as well is this U.S. recession risk indicators dashboard. And there has been some change from September to the end of October. We've seen retail sales run from a recessionary red in September to a cautionary yellow. And that's been an interesting look. And J.A. mentioned consumption. Of course, we're entering the Christmas season, and usually the fourth quarter is the best quarter of the year in terms of consumption. So we're somewhat optimistic on that. And I do believe that the consumer has been strong through this time period. The overall signal is still recessionary red, but we did have strong third quarter GDP, which I think was boosted by this consumption. The labor market, while there's been some recent changes to the negative, I think that's part of what's underlying the consumer and the spending. But it's important to note, and ClearBridge does a good job bringing this out in their report, that it's not unprecedented for the dashboard to improve beneath the surface after a red signal emerges, only to later worsen. This occurred in 1990, for example, while economic and earnings data currently provide a mixed view. ClearBridge expects clarity to emerge over the coming quarters as we move through the crux of this economic cycle. So consumption came in at 4%, accounting for over half of the growth in economic activity in the third quarter. And so we'll see. I think this is important to look at as we continue to go forward. But it's also a fact that consumption was positive in the quarter before the onset of each of the last 8 recessions. And it stayed positive even as the recession started in 5 of those 8 instances. So, we could see that continue to grow. We'll just have to pay close attention to it. So, and then as we look over time, going all the way back to the far right to 1969 to 70, you can see the dashboard of indicators there, which ones are red and which ones are yellow in each of those recessions. And in fact, the most recent one in 2020 had several that were green, probably due to the fact of the stimulus provided by the government during the COVID shutdowns. So probably not as much a recession as it was just a complete shutdown of the economy. So interesting to note. And as you can see at the bottom of that, for where we are currently, ClearBridge is forecasting a recession in the coming months. That they probably were on this last year if we went back 12 months ago. And so we've been bringing this to you guys each time we meet at the month to share with you what's taken place. If you would have listened to some of those loudest naysayers a year ago, you probably may have turned money to cash that was meant for longer term and would have missed out, just as Tara pointed out in the beginning, of some pretty robust gains this year, even for more conservative investors. Their portfolio is still up over what cash rates have provided. So it's important not to let your feelings or your emotions dictate how you invest money, but know what the risks are and then plan accordingly.
I think it's probably important to note as well that, yes, this recession dashboard has pointed to recession for a long time and still does. There are other leading economists that are still in the camp of thinking we will dip into recession at some point next year. There's another group that, as we've gotten closer to what a lot of folks feel is the height of the rate hike cycle, the top of the rate hike cycle, that maybe the Fed has been able to maneuver things to avoid it. So the verdict's still out on that, we would say. And so we want to, as I had mentioned earlier, we want to stay diversified and not invest in any one specific outcome until we get a little further down the road.
All right, switching gears a little bit. Each month we have been highlighting a financial planning topic, and this is just in hopes of sharing some ideas with you that are important and of interest. These items we talk about, we put these topics together collectively because we see them often with clients. And this year, or this month, I'm sorry, we want to talk about end of year charitable giving. As you know, charitable giving doesn't need to occur at the end of the year, but it becomes a time in which a lot of people that this is top of mind. I was even doing some research on charities, and many of them receive the bulk of donations at the end of the year. When we sit down and we're working with clients on their overall comprehensive financial plan, this is something that we definitely want to incorporate. So for first year-end, give an idea. Most common or most often people are giving cash. So whether this is cash or check, that is the most common form of charitable giving. This can reduce taxable income. The trick here is you do have to itemize in order to receive that specific deduction for that charitable gift. Next up is QCDs. Hopefully you've heard us talk about this at least a few times. So a QCD, a qualified charitable distribution, is a distribution that comes directly from your IRA and goes to the qualified charity. A few specific rules around this: you do have to be 70 and a half in order to use a QCD. This allows you to give directly from your IRA with, we'll call it, no tax consequences. So this directly reduces your taxable income. Sometimes, often we'll see people pull money out of an IRA and then give cash to a charitable organization. A better tax strategy, or at least most often better tax strategy, is to give directly from the IRA if you qualify. Also, if you're over R&D age, which is required minimum distributions, depending upon when you hit that age, maybe 72, 73, a QCD can actually satisfy that R&D. There are some limitations on how much, but the limit is pretty high. For next up is a donor advised fund, or you might hear us call this a DAF. It is a vehicle that's sponsored by a public charity and allows you to make charitable contributions into this public charity or fund in a particular year, and then at a later time decide exactly where you want to donate the funds to. And so the benefit of this is you do get the larger deduction during the year in which you contribute to the donor advised fund, and then at whatever point that you decide, you can then distribute that to the charity. The donor advised funds often are invested, so it can collect, dividends and interest, and then you can also donate that to charity as well. The next one is what we call bunching. It is a little bit different than contributing directly to a donor advised fund, but something to think about is if there is a year in which your income is higher, if you have a certain organization that you already give to, bunching maybe 2 years of donations into one. So let's say if you knew you're going to give 2023 and 2024, and we knew your income was going to be higher in 2023, can we bunch those donations together and then potentially maybe, hold off the next year, or maybe even give more? And that way, and this will allow you to be able to itemize those deductions. A lot of times put you over that standard deduction and be able to take that. And then lastly is mostly public traded securities you can donate to charity. So if you have a security that you've held for, you want it at least to be a year or longer, you can donate that to charity and claim the fair market value as an itemized deduction on your tax return. Again, there's a few limitations on that. But if you have, we often see this with maybe company stock or even, stock that you've purchased a long time ago, and it has a large gain. If you're charity inclined, one of the options is to donate that appreciated security directly to the charity, and then they can disperse it from there.
Thanks, Tara. Those are
Of
all
course.
great things to consider. And in the spirit of giving, just a couple things as we wrap up here. First of all, tomorrow is Giving Tuesday, so an opportunity to reflect on, look at your giving for the year, assess, pray about your giving between now and the end of the year. And then second, the Bible talks a lot about giving, and so we always kind of close these webinars with some biblical wisdom and truth. And if we look at 2 Corinthians chapter 9, verse 11, and then verse 15, Paul writes, you will be enriched in every way to be generous in every way, which through us will produce thanksgiving to God. And then just a few verses down, thanks be to God for his inexpressible gift. And so first of all, that first verse just addresses exactly what we're talking about, being generous and being blessed by being generous. But then I think it's always important to remember the greatest gift of all, which is referenced in verse 15. Thanks be to God for his inexpressible gift. And so just the gift of salvation through Jesus, through what was accomplished on the cross, his death and resurrection. And especially as we enter just the Christmas season, the holiday season, just for us, each one of us, just to commit to remembering and reflecting on and giving thanks for that greatest gift, I think is a great reminder for all of us.
Yeah, that's good. Giving breaks the power of money too.
That's right.
And we believe it all comes from God. So to be generous with that it's a feeling that is like no other.
Absolutely. Try it out if you haven't done it.
Yeah.
Test them. So with that, this wraps up our webinar series for the year. It's crazy to think about the end of 2023. But we thank each one of you for attending today, or many of you that have attended our previous webinars as well. We would say, we are here to serve you guys and to serve others, to be a resource. So if you have questions, or if you have others that would benefit from a conversation with us, we hope that you will either pass on a link to the video when we get that out. You can feel free to email that, or just mention us to those folks that you think might benefit, whether that be a neighbor, family, coworker. Again, we love helping folks. We welcome the opportunity just to continue to do that. Anything that I missed?
I think that's good.
I think so.
All right. Well, thank you guys again. And we hope you all have a Merry Christmas, a Happy New Year if we don't talk to you in the meantime. Take care and God bless.
See ya.
Bye.